Welcome to the deep dive. Today we're diving into something that trips up so many people, just
hmm
the sheer amount of noise in personal finance. You want to invest, build for the future, but gosh, everyone seems to have a completely different, perfect strategy.
Yeah, and our mission today is really to cut through that. We're starting with this kind of stark scenario. Imagine you lose everything tomorrow, wiped out. But you get to keep, say, 20 years of hard-earned investment knowledge. What's the absolute leanest, most effective plan you'd use to rebuild?
And the answer that emerges, it's actually surprisingly simple. It boils down to buying just three specific exchange-traded fund ETFs and then critically sticking with them.
Right.
This isn't about trying to outsmart everyone. It's about owning the winners, but efficiently.
Right.
So before we get into the specific three, let's just quickly nail down the basic tool here. What exactly is an ETF?
Okay, so think of an ETF like a basket. Instead of buying one apple, you buy a basket that holds maybe apples, oranges, bananas. In investing terms, one share of an ETF holds tiny pieces of dozens or even hundreds, sometimes thousands, of different stocks.
So instant diversification.
Exactly, instant diversification. It massively cuts down your risk compared to just betting everything on one single company's stock.
And the big draw, especially in this rebuilding from zero idea, has got to be the cost and how easy they are to trade, right? They're super low cost, and you can buy and sell them all day long, just like a regular stock, unlike some of those older mutual funds.
That's a huge point. And what's really fascinating is that this whole low-cost passive idea, it isn't just some academic theory. It's actually the strategy backed by, arguably, the most successful investor ever, Warren Buffett.
Right, he always says that.
Yeah, he said it repeatedly. For most people, the vast majority, the best thing they can do is just consistently put their money into a low-cost S&P 500 index fund. He even told his own family that's how the money left to them should be handled. Low-cost S&P 500 ETFs.
It's kind of the ultimate cheat code, isn't it? We hear all the time about these, you know, super smart fund managers with fancy MBAs who still struggle to actually beat the market average, often because their fees are so high.
That's the absolute core of it. See, the goal with this 3 ETF approach isn't to be some investing genius who beats the market by 50% every year.
Yeah.
That's incredibly hard, maybe impossible long term. The goal is much simpler. Just match the market. Because if you
Yeah.
can just match the S&P 500 index, you're automatically consistently going to do better than like 98% of those expensive, actively managed funds run by the pros. It's all about long-term success through sheer consistency and low costs.
That makes a ton of sense. So, okay, if Buffett's advice points to the S&P 500 as the starting point, that feels like the natural place for our foundation. Let's talk about the first pillar, the Vanguard S&P 500 ETF.
Yeah.
The ticker is VO.
Right, VO. This is really the cornerstone. It tracks the performance of the 500 largest companies publicly traded in the U.S. I mean, you're talking every big name you can think of, the Magnificent Seven, like Apple, Microsoft, Amazon, Nvidia are in there. It's essentially buying a slice of the whole U.S. economy.
And here's where that efficiency point really hits home. The expense ratio for VO, it's almost unbelievable, 0.03%. Can you break that down? What does that actually mean in dollar terms?
Yeah, it's tiny. 0.03% means for every $10,000 you have invested in VO, your total annual fee is just
$3 a year.
$3. Wow. Okay, compare that.
Right, now compare that $3 fee to your typical actively managed mutual fund. Those often charge somewhere between 1%, maybe even 2%. On that same $10,000, you're suddenly paying $100 or maybe $200 every single year. Just in fees.
Just in fees. And over, say, 30 years of investing, that difference, that extra 1% or 2%, it doesn't just nibble away at your returns, it compounds. It can literally mean hundreds of thousands, potentially even millions of dollars less in your account, purely because of unnecessary fees.
That's a staggering difference. It really highlights why just being consistent and low cost is so powerful.
Exactly. And because VO is passively managed, meaning there isn't a manager trying to pick winners, it just holds the index your job as the investor becomes really simple. It's all about consistency. And the best way to achieve that is through something called dollar cost averaging, or DCA.
Okay, DCA.
Yeah, DCA just means you invest a fixed amount of money at regular intervals, say every month or every quarter, no matter what the market is doing. Market's up, you buy. Market's down, you buy. You don't try to guess the highs and lows. You just end up buying at the average price over time. It takes emotion out of it.
Which is usually where people go wrong.
Almost always. Now, just quickly, there are other S&P 500 ETFs like SPY or SPLG. They're basically identical to VO in what they do, maybe slight differences in share price or exact fee, but VO is a fantastic, super low-cost choice.
Got it. So VO is the solid foundation. Let's move to the second pillar. This one sometimes generates a bit more discussion, maybe even controversy. It's for stability and income. The Charles Schwab High Dividend ETF, ticker SCHD.
Yeah, SCHD. It plays a really specific, often defensive role. It invests in companies known for paying out dividends, but specifically ones that are also high-quality, financially sound businesses. Think big, established names like Coca-Cola, PepsiCo, Cisco, Verizon.
And that stability factor is key, right? Especially maybe for someone closer to or in retirement.
Absolutely. These tend to be companies with really strong cash flows. They manage their debt well. What that means is when the overall market gets, choppy or heads south, these types of stocks often hold up better because investors tend to flock towards perceived safety and reliable income.
Okay, and speaking of income, what does it actually pay out?
Right now, SCHD's dividend yield is hovering around 4%. So again, using our $10,000 example, you'd be collecting about $400 per year just from the dividends it pays out. And importantly, it keeps the costs low, too. The expense ratio is only 0.06%, so $6 for $10,000.
Okay, hold on. Low cost, stable companies, a guaranteed 4% cash payout.
I don't think.
Why is there any controversy? Why are some investors, especially maybe younger ones, a bit hesitant about focusing too much on dividends? Isn't it just free money?
That's the million-dollar question, isn't it? The hesitation really boils down to taxes, tax inefficiency, particularly if you don't actually need that income right now, like a younger investor saving for decades down the road.
How so?
Well, think about it. A company makes a profit, say $1. First, the company pays corporate income tax on that profit. Then, if they decide to pay out some of the remaining profit to you as a dividend, you, the investor, have to pay personal income tax on that dividend income.
So it's taxed twice. Once at the company level, then again when I receive it.
Exactly, double taxation. Now, consider the alternative. What if the company didn't pay you that dividend? What if they kept that cash and, say, reinvested it back into the business to grow it faster, or used it to buy back their own shares?
Then the stock price should theoretically go up by that same amount over time.
Precisely. The value is still there, reflected in a higher share price. But the key difference is you don't owe any taxes on that appreciation until you actually decide to sell your shares, maybe many, many years later. It's tax-deferred growth.
Okay, that makes sense. So dividends aren't bad, but maybe not the most tax-efficient way to grow wealth if you don't need the cash flow immediately.
That's a good way to put it. So SCHD tends to be best suited for a couple of specific situations. First, definitely for generating that steady, reliable income stream in retirement when you do need the cash. And second, holding it inside tax-advantaged accounts like an IRA or a 401k.
Because inside those accounts, the dividends aren't taxed year after year.
Correct. They can be reinvested and grow tax-deferred until you withdraw the money in retirement. So for a younger investor focused purely on maximizing long-term growth in a regular taxable account, maybe prioritizing growth over dividends makes more sense. For someone like me who has other high-growth businesses, SCHD provides a nice stability hedge.
That's really clear. Okay, so we have VO for the core, SCHD for stability and income where appropriate. Now we need the growth engine, right? The
Right.
part designed for maximum long-term growth. That brings us to pillar number 3, QQQ, the NASDAQ Q100 ETF.
Yes, QQQ. This is definitely the high-octane component of the portfolio. It tracks the 100 largest non-financial companies listed on the NASDAQ Q stock exchange. So think innovation, think technology, digital infrastructure. It's heavily weighted towards names like NVIDIA, Meta, Facebook, Amazon, Microsoft, Tesla. Even Costco is in there.
Now, the cost here is a bit higher, right? Around 0.2%.
It is. 0.2%, so 20 per $10,000 invested. It's noticeably higher than VO or SCHD, but you're paying that slightly higher fee for access to a specific type of company, one's capable of generating really high returns on capital, or ROCE.
ROCE, return on capital. Okay, maybe I'll unpack that a bit. Why is ROCE so important here?
ROCE is, well, it's probably the ultimate measure of how effectively a company can reinvest its profits to generate more profits. Let's use a simple analogy. Imagine two lemonade stands. Both make, say, a $100 profit.
Okay.
Lemonade stand A reinvests that $100 into buying more lemons and sugar, and next year, that $100 investment generates $110 in profit. That's a 10% return on capital.
Got it.
Now, Lemonade Stand B also reinvests its $100 profit, but maybe it uses that money to buy a slightly better juicer or figure out a smarter location.
Mhm.
And next year, its $100 investment generates $130 in profit. That's a 30% OC.
Okay, yeah, Stand B is obviously going to grow much faster.
It doesn't just grow faster, it grows exponentially faster over time. A company that can consistently achieve, say, a 30% return on the cash it reinvests is going to become vastly larger, like several magnitudes larger over decades, than a company only getting a 10% ROC, even if they start with the same amount of profit today. QQQ is packed with these high ROC potential companies, and that's why investors are often willing to pay a premium valuation for them.
But that focus on high growth and high valuations, it also means QQQ can be pretty scary when the market turns, right?
Mm-hmm.
Volatility must be higher.
Oh, absolutely. High reward comes with high risk. When the market gets nervous or there's uncertainty, these are often the stocks that fall the hardest and fastest. QQQ is where you can see some real fear play out. I mean, during the dot-com bust back in the early 2000s, QQQ fell something like 80% from its peak.
80%? Wow. That's enough to make anyone want to sell everything and hide.
It really is. It tests your conviction.
So what's the mental trick? How do you stomach that kind of drop without panicking?
The trick, if you can call it that, is understanding that time is your biggest ally, especially with growth investing. And here's a really compelling statistic. Even if you had the absolute worst luck imaginable and bought QQQ at the very peak of the market, right before the crash in March 2000,
Quite.
and you just held on, you didn't sell, you rode it all the way down and all the way back up until today. Your annualized return over that entire period, despite buying at the worst possible moment, would still be around 14% to 14.5% per year.
No way. Really? Even after an 80% drop?
Yeah. It underscores the power of just staying invested. Time heals most wounds in the market, especially with innovative companies that eventually recover and keep growing. Trying to time the market, jumping in and out based on fear, it's almost always a losing game. Consistency wins.
Incredible. And I guess the takeaway there is also about allocation. If you're younger, say in your 20s or 30s, you have decades to ride out those waves, so maybe you can afford to allocate a larger chunk of your portfolio to something like QQQ compared to someone nearing retirement.
Precisely. Your allocation between these three, VO, SCHD, QQQ, should absolutely depend on your age, your time horizon, and frankly, your personal tolerance for watching your portfolio value swing up and down.
Okay, this is great. We have the three pillars defined. VO for the core, SCHD for stability income, QQQ for growth. Now let's bring it all together with some numbers. This is where the impact of fees versus efficiency really becomes crystal clear. Let's compare our 3 ETF low-cost approach against the typical high-fee, actively managed fund.
That sounds good. Let's set up a realistic scenario. Imagine you start investing at age 30. You've already got $100,000 saved up, maybe from an inheritance or previous savings, and you commit to saving an additional $10,000 every single year until you plan to retire at age 65. That's 35 years of saving and growth.
Okay, 30 to 65, $100 case, start, $10 per year. Scenario one, you use our low-cost ETF strategy. Let's assume a reasonably conservative long-term average return for a balanced portfolio like this, maybe 9.5% per year after those minimal ETF fees. What does that look like at age 65?
Okay, running those numbers. At age 65, your portfolio grows to approximately $6.6 million. And based on standard withdrawal rates, that $6.6 million should comfortably last you until you're about 95 years old.
$6.6 million, last till 95. That sounds like a pretty successful retirement plan right there.
Absolutely. That's a fantastic outcome built on simplicity and low costs. Now, let's run scenario 2. Same starting point, same savings habit, but instead of the low-cost ETFs, you choose a typical actively managed mutual fund. We need to factor in that higher fee, let's say 1% extra per year, plus the historical tendency for active funds to slightly underperform the market index. So let's adjust the net return down from 9.5% to, say, 7.5%.
Okay, so just a 2% difference in annual return because of fees and slight underperformance. What happens to the final number?
That seemingly small 2% difference is devastating over 35 years. Instead of $6.6 million, your retirement balance at age 65 is only $4 million.
Really guessed. Wow. From $6.6 million down to $4 million. That's a $2.6 million difference purely because of choosing the less efficient, higher cost option. And what about how long the money lasts?
That's the other kicker. With only $4 million, withdrawing the same amount you would have from the $6.6 million portfolio, you run out of money completely by age 83.
Broke at 83 instead of comfortable until 95. That's the real tangible cost of high fees and chasing complexity, isn't it? $2.6 million lost and over a decade of financial security gone.
It truly is. It's the silent killer of wealth building. But let's flip it around. Let's look at the positive impact of optimization within our low-cost structure. What if we strategically allocate, say, 20% of that portfolio to the growth engine, QQQ? Based on historical returns, that could potentially boost the overall portfolio's average return slightly, maybe from 9.5% up to around 10.3%.
Okay, so less than a full percentage point increase from 9.5% to 10.3%. Doesn't sound like a massive jump.
You wouldn't think so, but remember the power of compounding over 35 years? That bump from 9.5% to 10.3%, it takes the final retirement value from $6.6 million up to $8.17 million.
Just from adding that 20% QQQ allocation.
Yep. Almost $1.6 million more just from optimizing the mix within the low-cost framework. It shows that small tweaks in return, especially when costs are low, have enormous long-term consequences.
That's incredible. Now, the source material we looked at also touched on something a bit more advanced. Generating some extra income using option strategies like covered calls or cash-secured puts. That sounds significantly more complex.
It is definitely a step up in complexity, requires more learning. It's not for everyone, certainly not for beginners, but the concept is interesting. Strategies like covered calls, where you basically agree to sell your shares if they hit a certain price, or cash-secured puts, where you agree to buy shares if they fall to a certain price.
You get paid a premium for making those agreements, right?
Exactly. You collect cash up front, called premium, for taking on those obligations. Used carefully and conservatively, these strategies can potentially generate an extra, say, 1% to 4% return per year on the assets you already hold. It's like renting out your shares for extra income.
Okay, so just hypothetically, if someone were able to add, let's say, an extra 1.5% per year through strategies like that, on top of the optimized 10.3% return, bringing the total average return to maybe 11.8%, what would that do to the final number?
Now we're really seeing the leverage, starting with that $6.6 million base case, boosting the return to 11.8%. The final nest egg at age 65 explodes to $12.1 million.
12.1 million, good grief.
The point isn't necessarily that everyone should rush out and learn options. The key takeaway is that once you nail the foundation, the low cost, the diversification with these 3 ETFs, even small incremental improvements in your average annual return, whether through asset allocation or other means, can lead to absolutely massive differences in your final outcome thanks to compounding. Consistency and optimizing returns are where the big wins are, not necessarily trying to find the next 10-bagger stock.
That really drives it home. Okay, so let's quickly recap the mission here, rebuilding wealth from zero or just building it efficiently from wherever you are. We've got the 3 core pillars. VO, the Vanguard S&P 500 ETF, for that broad, stable exposure to the U.S. economy. Super low cost.
Yep, the foundation.
Then SCHD, the Schwab High Dividend ETF, for stability and income. It shines particularly in retirement or inside tax-deferred accounts like IRAs and 401ks because of that double taxation issue with dividends in regular accounts.
Right, the defensive income play.
And finally, QQQ, the NASDAQ Q100 ETF. That's your dedicated growth engine focused on innovative companies with high returns on capital, but it comes with higher volatility that you need to be prepared to ride out.
The growth accelerator. VO, SCHD, QQQ. A simple, powerful base.
And the overarching lesson, it seems, isn't about complexity or trying to outsmart Wall Street. It's about ruthless efficiency, keeping costs dirt cheap, and just being relentlessly consistent with dollar cost averaging. Let the market work for you over time.
That's exactly it. That foundation, built on those principles, protects you from the biggest wealth destroyers. High fees and emotional decision-making. It sets you up for success almost automatically.
The true power of keeping it simple.
Absolutely. And, for many people, maybe that's enough. Building that 3 ETF portfolio provides a fantastic, robust baseline for achieving financial independence. But here's maybe a final thought to leave you with.
Okay.
Don't necessarily stop there if you find this stuff genuinely interesting. While these ETFs are great for matching the market and beating most pros, the biggest potential edge, the thing that can truly lead to market-beating returns over the long haul, often comes from taking the next step, learning how to properly analyze and value individual companies.
So use the ETFs as the core, but maybe learn stock picking on top of that.
Kind of. Use these three ETFs to secure your financial foundation, get that compounding working for you reliably. Then, if you have the inclination and the time, use your additional resources or savings to learn the skill of valuation, of finding those truly exceptional businesses that the market might be mispricing. That's the skill that can potentially add another layer of significant wealth creation on top of this already powerful base. It separates the good investors from the truly great ones over the long run.